Okay, so in this exercise, we have an NPV that is pretty low, consider that we have a $1.5 million investment. Okay, so what the company can do to boost its NPV is that it can purposefully beat down the ending book value they originally reported to the IRS. So let me mark it here. Okay, and so if they have a lower level for the ending book value, then they would have more annual depreciation on the book. And the annual depreciation, as I mentioned earlier, will help the company to save some tax. Okay, as I said, when depreciation goes up, they have a less taxable income, so they have a less tax to pay, assume the same tax rate. Okay, so here is something I want to do. I'm going to change the ending book value of the equipment, and I want you guys to observe the annual depreciation and also the tax on capital gain, okay, and also the taxes the company pays every year, and also the NPV, all right? So just to observe all these factors. So I'm going to purposefully beat down the ending book value of the equipment from $150,000 to zero. So what happens is when I have less ending book value for the equipment, the total depreciation is increased to $300,000, okay, per year. And then because the salvage value is $300,000, so that's my entire capital gain, I pay more tax on capital gain. And my annual tax decreased from $80,000 to $68,000. So basically, that's a negative $12,000 per year. Okay, and my NPV increases. Do you see that? My NPV increases from $900 to $10,000, and that's a dramatic improvement. So the key trick, the trick here basically is if I beat down the ending book value, depreciation goes up, and then my operating cash flow increase from $390,000 to $402,000, and that boosts my NPV. And of course, I will have a concern here. My ending salvage cash flow is reduced because I pay more tax on capital gain now. All right, but still the net effect is a positive NPV. So who is on the losing side of the deal? We know that the company, by doing this, would end up with higher NPV. So the company definitely has incentive to do such a thing. And IRS actually is a losing party. If you look at the taxes here, okay, and here, okay, so for each year, the company saves $12,000 tax, and at the end, the company pays more tax on capital gain from $60,000 to $120,000. So that's a $60,000 more tax to pay. Oh, that's my Facebook message. Never mind. $60,000 tax rate to pay. So you can see that $12,000 per year times 5, that exactly equal to a $60,000 tax. So at the dollar figure, the IRS is not actually losing money, okay? Because you have $12,000 here and you have $60,000, so the dollar figure match each other for the capital gain tax and also for the corporate tax. However, the time value of money needs to be concerned here. This $68,000 is definitely worth more than this $68,000. As we covered earlier, that $1 today is worth more than $1 5 years later. Okay. Likewise, if the company can save $12,000 in year one, definitely that $12,000 is worth more than $12,000 5 years later. So, although the dollar figure for tax saving and the increase in capital gain tax is the same, but the IRS lose the time value of the money. Okay, so that's the reason that IRS is not happy with such a manipulation. Okay, and another thing is the company save corporate tax at a 40% rate, and the capital gain tax in this country is actually less than 30%. Okay, the capital gain tax rate is less than 30% or 20%. So basically, the company saves a lot of taxes, but only pays small amount of additional tax on capital gain, and that's also not fair. Okay, so right here I can change it to 20% from 40% to adjust for the tax rate on capital gain. So the company basically saved a lot by doing this. So as I mentioned earlier, the IRS will not be happy for such a behavior. So let me just recover whatever I had before. Okay, and this is also $40,000. Okay, the IRS is not happy with such a behavior, so they will do everything in their power to eliminate such incentive. Okay, so the best they can do is to apply a new method which leaves no room for company to manipulate the ending book value here. Okay, so basically the company cannot just say, I'm going to put out $150,000 or $120,000 or $0 for ending book value. The company has no freedom of doing such a thing. Okay, they have to follow the rule designed by the IRS. Okay, so that rule is actually called MACRS. In particular, this is the modified accelerated cost recovery system. Okay, that is a system that let the assets depreciate at a certain level per year, regardless of the company, regardless of their way of accounting procedural. They always give the same numbers. Okay, so for our original case right here, which is a Speedo case, we can do such a little adjustment. We make the depreciation method changed from a straight line to MACRS. And this equipment, again, is a 3-year equipment, okay? And so we're gonna use the 3-year column from the Macrs table to calculate the annual depreciation as well as the ending book value. So here is the Macrs table. Okay, so we have a different classes of assets. Okay, and they each have a certain time period of a life expectancy. We have a 3-year assets here. We have 5-year assets here. 7, 10, 15, 20. Okay, and 3 years usually for high technology equipment. 5 years is usually for office supplies. 7 years for the production lines and some machineries in manufacturing industry, and 10 years usually is a vehicle. 15 years, 20 years are usually real estate assets. Okay, let's just take a look at the 3-year assets. Okay, so we have 4 numbers in this column. Okay, the first number is a 33.33. Is actually a percentage. Okay, that means in the first year, these 3-year assets depreciate its value by 33.33%. The second percentage is 44.45%. It increased from the first year's 33%. Okay, the depreciation speed accelerated in the second year. That's why it is called accelerated system. Okay, so from 33 to 44, there's acceleration of depreciation speed. Okay, in the third year, the depreciation drops, okay, to 14.81%. So basically, the machine got its value reduced mostly from the first 2 years. Okay, and we have a fourth number here. Well, wait a moment. Is it a 3-year assets? Yes, it is. But why do we have 4 numbers here? The last number here, 7.41%, is the remaining value of the machine, which is the value left after 3 years of depreciation. So assume you have a 100% of value. After first year, 33% is reduced. After second year, 44% is reduced. After third year, another 14% is reduced. So after 3 years depreciation, the only thing left is 7.41%. And this 7.41% is the ending book value. So that means when the company reported to the IRS for the ending book value of the equipment, they have to report at 7.41%. There's no room for manipulation. The company cannot just purposefully beat down the ending book value to get some benefits from a tax saving. If we apply this change to our Speedo model, so the machine actually is worth $400,000, and the first year depreciation is 33.33%, multiplied by 200,000 base value, so that's $66.66,000. And we have a second year depreciation, which is the number I borrow from Macrs Table, multiplied by the base value. That's the second year depreciation in dollar figure. I do the same thing for the third year. I do the same thing for the last number, last percentage, to get the ending book value. Okay, so for a $200,000 machine, the first year depreciation is $60,000, the second year is $88,000, the third year is $29,000. So after 3 years depreciation, the ending book value of the machine is $14.82,000. Okay, and then I apply this change, the depreciation, okay, to the capital budgeting table. So the depreciation basically is a thing changed here, and that's going to change my taxable income, change my tax payment, and also I need to add back depreciation, and this is going to change my operating cash flow. And another thing change here is my salvage cash flow. As you can see that I still will sell the machine for $30,000, but the capital gain is going to be based on a different number. Okay, the ending book value there, as I report to the IRS, is $14,820, and there's no room for me to manipulate, and I cannot just beat down the number, so it has to be following the IRS rule. Okay, so I have a changed tax on salvage, and then eventually I have a different cash flow from salvage, and then the operating cash flow plus salvage cash flow, all these changes applied there, and I have a different net cash flows or free cash flow. Then I would have a different NPV.